Good afternoon, good morning, whatever time zone you might find yourself in terms of this event. My name is Patrick Driscoll. I'm thrilled that we have had well over 80 participants and registrations for how to set your VC up for success. I see the future of VC in this room. I'm super stoked to have you all here. And we're here to really provide insight and advice to all of you from our wonderful and experienced guest, Rita Astoor, who I'll introduce a little bit later. So while we wait for the last minute stragglers to hop on, I'd like to provide a brief overview of StartOut before diving into the way more interesting content that we have set up for you. So StartOut is a US-based nonprofit organization founded in 2009. It focuses on really supporting the LGBTQ+ ecosystem, specifically entrepreneurs and startup founders, but we're moving more into a direction of empowering investors and connecting the dots there as well. So the mission is to increase the number, diversity, and impact of the LGBTQ+ entrepreneurs, and also to amplify their stories, ultimately to drive the economic empowerment of the queer community. So over the past 10 years, StartOut has had a ton of success. So there's been a community of over 17,000 members that have been built. We've supported 300+ entrepreneurs every single year. We have fantastic programs like our Growth Lab. We have experts that are available to mentor at any given time. I personally am a mentor for several companies through StartOut. We have expertise in fundraising, et cetera, and we have a ton of amazing events, so feel free to check them out. One quick plug, it's the last day to apply to Growth Lab. So if you're interested in that accelerator incubator program via StartOut, make sure that you apply today. And if you want to get involved in StartOut in any other way, check out startout.org, where you can join as a member. You could either do it as a founder or an investor. And that's where you're going to find a list of all of our upcoming events, which are super thought-provoking. We bring in industry leaders, great investors, voices that are pushing the envelope for LGBTQ+ founders and investors throughout the US and abroad. And I'm specifically looking at all of you aspiring fund managers. Get involved. We have an investor portal as well, where you can get access to fantastic deal flow. So and a quick shout out to our sponsors. We wouldn't be able to exist without these amazing folks. And before I pass it off to Rita to introduce herself and then hand it off to her to run through her amazing presentation before opening it up, I wanted to run through some logistics. We have a chat function and a Q&A function. We're going to open up the session to questions and answers, where both of us will be providing responses, but make sure you use the Q&A function, not the chat function. So we're not going to be monitoring the chat. With the chat function, you can introduce yourself, share your LinkedIn, provide where you're perhaps calling from. But then the Q&A is really where we're going to get into the nitty-gritty of answering your questions. So keep that in mind. We'll remind you if you provide some questions in the chat. All right, just now getting to the introductions of our wonderful folks. My name is Patrick Driscoll. I wear many hats. My day job is actually with Carta. I lead the product marketing for our VC suite of offerings. So I work specifically in fund benchmarking data. I am super tied in with our data team. I run our crypto strategy for our product development and do upmarket initiatives specifically. I also am a general partner at Chasing Rainbows. It's an LGBTQ+ focused fund that was launched earlier this year. I'm in the midst of setting up our fund for success myself, so this topic is super relevant for me, and I'm happy to provide insights later on in the presentation. We've actually onboarded with Carta, and we use several other VC tech stack opportunities to make our lives way easier. So I have a lot of advice and feedback regarding what you can do to set up for success. In addition to Carta and Chasing Rainbows, I'm a venture partner at Angels. I source deals for VC funds all over the globe as well. And then I actually sit on the VC and investor board here at StartOut. So I create great content and find fantastic speakers like Rita, who you're about to meet, to come to these types of events on the regular. So happy to talk about all of those things. If you want to reach out, connect with me on LinkedIn, and we'll go from there. And now I'll pass it off to Rita to introduce herself. I'm super thrilled that she's here with us, and then I'll stop sharing, pass the screen off to Rita, and we'll get started.
Awesome. Thank you so much, Patrick. And thank you for having me. Thank you to start out. I'm super excited to get involved and support the organization and this community as much as I can. By way of background, I was formerly an investment funds attorney at big law firms in New York before joining Carta. So with that background at Carta, I lead our venture capital business development team, as well as work with our product teams in terms of what they're building. So what that means for us is kind of thinking about both product, customer, client, and audience to think how can we accelerate and build the right tools for the right people, and talking with every single person in the industry, whether it's law firms, banks, auditors, tax providers, and anyone else, in terms of what it really takes to help support and accelerate growth in the venture capital space. I guess I'll note that as of next semester, I'll also be teaching a venture capital funds class at UC Berkeley's law school. So if anyone is there or knows friends there, send them my way. Patrick, do you want to pass over?
Absolutely.
Perfect. And there you go. And so in thinking about what would be most helpful in terms of how to set up a VC fund for success, Patrick and I were discussing shortly, and we thought it might be helpful to just lay groundworks in terms of just basics and fundamentals. And from there, I'm sure you all will have tons of questions, and I'd be happy to like jump into whatever direction or angle that you all are most interested in. So for now, I'll just quickly kind of run through kind of a VC overview and fundamentals, and we'll take it from there. Not legal advice, just thought I'd say that. If you actually, have specific questions about your specific fund, definitely talk to a lawyer. This is my disclaimer, which is like in the spirit of kind of doing a quick overview at a very high level. There are going to be probably exceptions, variations, a lot more nuance to any particular thing I say. And so again, this is like hopefully to get everyone on the same page, and then we can dive more deeply from there. So this is kind of what I plan on quickly running through. All right, so first, like situating venture capital within alternatives and within assets more broadly. So if we think about things like people buy, people invest, the ways that people are interested in making money, a lot of people are familiar with stocks and trading. And if you think about that, that's like a piece of fractional ownership of a public company. What does a public company mean? It means it's listed on a stock exchange, and there are typically little to no restrictions on kind of like who is buying and selling these types of assets. Very easy to buy and sell, and very easy to understand price discovery, because supply and demand happens almost immediately. You can kind of track exactly how pricing goes, and you can kind of offload or unload at a time, which is why there's at any time, which is why there's this idea that these are quite efficient, right? The markets are determining the price themselves, and it's quite liquid because you can kind of buy and sell at any time. It's important to have that framework because it stands in kind of contrast to what we think about as alternative assets. And alternative assets are to kind of put into sphere, if those assets, the traditional assets are public, these are all private. What does that mean? These companies are not listed publicly, so that if you're buying fractional ownership or whole ownership of these companies, there is no open, transparent market where supply and demand is telling anyone who looks kind of what the price is sitting at. That also means it's harder to buy and harder to sell. You're buying chunks of private companies, and there is no immediate market where buyers can show up and also offload this onto. And so it is not as liquid as what the public markets would be. Why are people interested in doing this? Well, the idea is that you'll have outsized returns, and depending on the stage at which you're investing, that stage is probably an indicator of some greater amount of risk. And with a greater amount of risk, the idea is hopefully you'll also be able to hopefully attain a greater amount of return. But because it's not on a public market, inefficient, price discovery is a big issue. Finding buyers or sellers is a big issue. The transaction costs themselves are higher. But again, these are the fundamental differences between public and privates. and they're less regulated, right? When companies are on a stock exchange, you have quarterly reporting, you have annual reporting. All of them have very specific definitions and regulations on what you're supposed to say and what you need to show. A lot of that does not quite apply in the private space and where venture capital sits. So if we think about what the alternatives kind of cover more broadly, there's private equity, there's venture capital, there's real estate, there's hedge funds, all of these kind of tools. And so within that, I think like this might be a helpful way of thinking about kind of like where venture capital sits within these stages, and also what that means for that risk return profile. So if we think about like two founders in a garage and they're the ones who need capital, and that's where you want to make an investment, quite risky, right? Like day one of a company to be able to put your money behind that and say that you're investing in it. That's what we see here at the seed stage level, very risky. The idea again is like with that super high amount of risk, there'll be an outsized reward. Venture capital, I think nowadays kind of tends to cover everything from the seed stage all the way to this like early stage to growing. And so you can think about that as the companies are maturing, that's kind of determining their stage and maturity level and also risk profiles. And that's the different places that the investments are being made. Nowadays, there's starting to become a blurring of venture capital and private equity, where the PE firms are kind of coming down into earlier and earlier investments. The VC funds kind of want to hold on to their investments later and later. You'll see like a new area called growth equity. You can think about that kind of in the middle, which is like, all right, you're not really a startup anymore. You have good product market fit, you have a customer base, but you still need capital in order to grow, and you're still too small for what private equity tends to look like. You can see that kind of in between these two circles. And then private equity all the way through a buyout strategy, kind of much more mature companies. And, you know, if you're interested, we can talk about this, but because of the interests, because of the different ways of what it means as an investor to invest in these companies, PE buyout tend to buy majority holdings. They tend to have, you know, active management of these companies, sit on boards, deal with the strategy. And a lot of the value they bring in terms of making these investments are their own network and expertise in each of the areas that their portfolio companies sit in. It's very different from venture capital, which tends to have minority holdings, kind of passive management of the portfolio companies. Maybe you have board observer rights, maybe not, but really like you're making an investment to go on for the ride. So just want to put that out there. Happy to dive into more details in terms of like how VC relates to other strategies. Quickly now running through, okay, so venture capital business objectives are to find early-ish private companies and make investments, minority investments typically, in order to ride that like risk return wave, right? So how do these things get structured? So I'm going to use a lot of pictures. The pictures are not mine. You should easily be tell, but hopefully it'll mean that all of us can go through this kind of together and be able to follow kind of what the structures end up looking like. Oh yes, I thought animations were cool, so there'll be a lot. I'm not sure that they are. So we're going to cover each one of these kind of concepts and how they all relate to one another. All right, so let's start with the actual funds. If you think about what the venture capital fund is, the fund is a pool of assets. Basically, you're getting a lot of different people to put in their own amounts of whatever it is into a pool, hence the picture. And the pool is going to be used to make your investments into other things. So the fund, whenever we talk about the fund, the venture capital fund, think about that as the entity that is set up specifically to pool together lots of assets. Then we think about the limited partners. Limited partners are the third parties who are each putting in assets into that pool. So they don't necessarily need to be the same, and they each have their different profiles, but they're the ones who are putting money into the pool so that someone else can go do something with it. Now, limited partners have a variety of types. See my animations. Just to quickly kind of highlight what the different profiles of LPs might be. You might have high net worth individuals. These are people with lots of money who want to invest. Maybe they worked in a startup, maybe they got bought out, maybe they had like a big payout, maybe they're just, you know, very successful in whatever they did. But either way, they're individuals who have money who are putting it to invest. There are family offices. So these are families who are pooling their assets together in order to invest. There are public pension plans. So think about all the retirement benefit for government employees at different state levels. They each collectively put all their retirement money into pools together. And then people who manage those pools turn around and invest it into venture capital. So for example, all the public employees of California, all the public employees of New York, each of them belong to different organizations that are kind of pooling the assets together. You might imagine they're huge, and they are in turn investing at least a portion of those assets into venture capital. There's private pension plans. So think about huge companies, insurance companies, other like private companies who themselves are pooling their own employees' assets and then investing it into, VC as one of their strategies. Corporate venture capital, that you can think about basically what private companies who are investing in venture capital, but for specific reasons. So unlike someone who's doing it in order to provide retirement income, let's say for their employees, CVCs are actually interested in doing venture capital investments, both as a way to understand the competitive landscape for the areas that they're in, but also as ways for their own R&D. So you can think about this as like all of the cell phone providers, Verizon, whatever, may have their own CVCs where they're investing in companies who are, let's say, focused on telecommunications or focused on broadband or internet or whatever it happens to be. So for them, it's a way of both scoping out competition for whatever their industry is, but also potential acquisition targets, technology. And it'll be interesting because if that's your goal, as opposed to, let's say, providing retirement assets, then the types of things you'll want when you enter a fund are fundamentally going to be different, right? So if that's your goal, when you invest in a fund, you say, hey, not only do I want to invest in your fund, but I actually want to hear about every single portfolio company that you invest in. And I want to be able to see all the information they provide. And so as you go through each of these like bullets, each of their incentives are going to be different in terms of why they're investing in a fund and therefore what types of rights and what types of visibility they're going to want in the fund. So also want to split out that CVCs, for example, could be direct, meaning a company is investing straight off of its balance sheet. They don't have any separate thing. They're just like, we're going to allocate X amount and go off from the main bank account. Or you can set up a venture arm, meaning the company itself sets up its own fund or its own pool in order to manage the investing, and therefore will have its own needs in terms of being able to report back all of its like results, performance, etc. Sovereign wealth funds, you can think about this as like state level government entities that are investing. Like Norway has a giant sovereign wealth fund. They invest all over alternative assets. Other funds or a fund of fund strategy. So say the CVC venture arm is investing in your fund that happens to focus on telecom, right? So it is a fund of, you can have a fund where all of your underlying portfolio company investments are other funds. And we can talk about why people do that, what some of the benefits or cons are there too. University endowments, Stanford, Harvard, all these schools have giant endowments. What do they need? They are trying to keep investing as well as have some liquidity in order to be able to pay for the things that the university needs. So their incentives and the types of protections like they will want when investing in a fund will differ. That was very quick. We can come back to this if people have questions. I don't know how many of these graphics I put in here, but there you go. The shut up and take my monies. We can think about them for our purposes as the LPs. Finally, right now we're going to talk about them together. We'll separate that out in a little bit, but the GP or the management company, you can think about this as like the person actually managing the pool, right? The pool of assets where the LPs put their money into. Well, someone is making decisions on where to invest it. Someone is the visionary. This is the person who says, I can see the next big thing. Give me your capital and I will go make it more for you. They're the ones making decisions. And so this is our Ash Ketchums of the world. And then what are the portfolio companies? Obviously our Pokemon. So these are the companies in which you are investing. These are the new startups. This is the new thing that you are first to hear about and you think is going to be a giant thing. These are the bets you're making. All right, so if we start trying to combine these together to see how they fit, right? So your third party LPs are going to be the people who put money into your pool, which is the fund. And the fund managed by Ash Ketchum is going to turn around and go invest in various startups, aka your Pokemon. And so let's continue building this out a little bit more further. So in the middle, the venture fund again is your pool. To the top right, the people putting money into the pool are your LPs that take my monies. The people managing the pool, top left, is going to be the general partner and management company. We'll talk about those differences. And what you turn around and invest in at the very bottom are each of your investments, which are each of your portfolio companies, also known as our Pokemon. And so take away all the silly graphics, what do you end up with? Which is a legal structure chart, which is how it all fits together. So hopefully you all can follow this again. In the middle, I'm looking at the left side of the diagram. The middle is your VC fund, typically structured as a limited partnership in Delaware. What you'll see to the left of that are your LPs. They're the ones who are putting money into the fund being the collective pool of assets. The fund itself is managed formally by the general partner entity, which is going to be set up by the management company in order to manage the investments. And at the bottom, you'll see the fund therefore uses its assets to make various investments in portfolio companies. I like putting this chart together because if you kind of step over to the right-hand side, if you think about what it looks like for a basic SPV structure, and I think there's a whole lot of developments in the SPV land, which we can also talk about, but you'll notice that it's basically the same idea, except instead of investing in multiple portfolio companies, SPVs tend to invest in one company. So SPV stands for special purpose vehicle. It's special purpose in the realm of venture capital, as opposed to different places where SPVs can be used for different special purposes. In the realm of venture capital, its special purpose is usually to invest in a portfolio company. And the basic institutional structure of how you do it looks the same, where you have your own setup pool, you have the LPs who put money into it. You may or may not set up your own GP to manage the pool. And again, there may or may not be the formal relationship with the ongoing management company. I'll just like put an asterisk here because there's a lot of developments in the space for different types of SPVs for different purposes. So some people have started using master series structure. So why do I want to set up a pool and its own GP every single time that I want to invest in a portfolio company? Delaware now tells me that I can set up one pool and just add sleeves underneath it. All of it is going to be a lot more efficient. All of it is going to be a lot easier to manage. So there's been like a lot of innovation on that side of things. Happy to talk into more detail about some of these other differences. And now kind of coming back to what I mentioned earlier in terms of the GP versus the management company, like what's the difference and why? If you think about it, each pool has its own LPs, the fund has its own LPs and has its own investments that it's going to make. So if anything were to go horribly wrong, those LPs, that pool, and the formal general partner entity that is set up to manage it are going to be exposed to liability. Any limited partnership has to be managed by a general partner, and that general partner is formally, legally responsible for managing the affairs of that pool, and also is going to be exposed to the liability from that pool. So say you are a manager and you have 8 different funds. Maybe they're all different strategies. Maybe they're all following up, whatever it happens to be. But if something goes wrong in one fund and turns out you owe a lot of money and you have to pay a lot of money and you're exposed to a bunch of liability because of that one fund, well, you wouldn't want all of the earnings, all of the work, all the profits across all 8 of your funds to be exposed to the risk from any individual pool. So for that reason, instead of using one common entity to manage every single pool, typically what you do is you set up a different general partner for each of your formal funds, the pools. And that way you can isolate liability to that general partner as opposed to like everything that you're doing. And so the way that it tends to happen is you'll set up your own GP. The GP will have the specific general partners who are set out to manage the strategy or the affairs of that fund. But what the GP then does is turn around and contract with another entity that you will set up, which is the management company. Now, the management company is actually the like evergreen, everything is housed at this level. The management company may rent an office space. The management company has employees. It has a subscription to the Wall Street Journal and to the New York Times. So that is the entity where all the ongoing affairs happen. But what happens is the GP of any particular fund will instead turn around and say, hey, management company, we'd like to hire you to manage the investment decision opportunities of this pool. And as you can imagine, the general partner, the management company, they're typically the same people, maybe a different subset of the same people. And so that's how we can think about the GP and the management company relationship. That also means that like as different funds get sunsetted, you know, people are still formally connected evergreen way to the management company. It also makes sense from like an efficiency standpoint, right? Like I don't need a different office for each fund. I don't need a different Wall Street subscription for each fund or Bloomberg terminal or whatever it happens to be. There are efficiencies of scale. Of course, you can look into the LPA. That's where you'll have things like devotion of time. How much of your business time do you spend on any given fund, et cetera, et cetera. But this is why you have a different GP from the management company structure setup. Happy to answer any questions about that towards the end as well. Setting that up also, okay, so I am so sorry, but the headings and the paragraphs in the slide are flipped. So bear with me on, this is kind of supposed to be the core of how VCs make money. And so you have a pool, you manage it, you make these investments, the investments exit. What does this mean in terms of making money? Well, all of you may be familiar with what's called like a distribution waterfall, which is the order in which any money that comes back to the fund gets paid out. So part of it is pay back to your LPs, like everything that they've put in so far, make them whole. And part of it is like, well, what do you do with the remaining profits? So profits, if we think about it, again, sorry, flip the headings for this. The GP basically says, look, if we have any like core profits after everyone's made whole, I'll take 20%, LPs, you can keep 80%. I know it seems like 20% may not be a lot, but this is truly how VCs, GPs in general tend to make a whole lot of money. And that is what is considered and called carried interest, because that is the amount of the distribution waterfall that gets strictly paid back to the GP as their like profits interest. Now, remember we said we had that formal arrangement with the management company, and the management company was formally providing investment advice. That's where the management fees go. So in exchange for providing those services, the GP agrees that the fund will pay 2% generally to the management company for their costs and services in providing investment advice to the fund. And so there's a lot, if people are interested, in terms of like how management fees stack up, so happy to go into that as well. So to put this back on our visual so that you can see how it fits. So this is exactly what we looked at before, but instead you can see that the 20% profits for the carry go up to the general partner. You can see the 80% of returns goes to the LPs, and then you can see the 2% management fees that get paid for the management company. Important to know that the management fees get paid regardless of whatever the performance happens to be. That's part of the costs and expenses of the fund, is like, these are the fees you have to pay the management company. In opposition to that, the return from any investments depends on getting returns from your investments. So if you're a fund, you make investments, nothing returns any money to you, they all go to zero. Well, then none of this 20%, 80% split is happening, right? And so you also need your returns to make enough so that you are paying everyone back the amount they put in, and that there are profits to then be segregated into the 80 and 20. This I won't go into in detail because I'm cognizant of time. I see lots of stuff in the chat and Q&A. I want to make sure we can get to any questions or discussion. Happy to return to this if it's quiet or you want me to dive into it, but this is kind of an oversight of kind of what are the fund documents? What are the pieces of paper that you put into place when you're kind of setting up these structures? what are the main regulations that govern these structures, and what are the main differences, exemptions, things that you rely on, which you may have heard of. So in like 2 minutes, again, happy to return to it if people want to focus on these. The main fund documents, particularly in VC, will be the LPA and your subscription documents. The LPA is the legal document governing the terms of the fund, the limited partnership pool that we talked about. And that is the document where it will say, like, here's how people can become an LP in the fund. Here's how much notice they got to give me a capital to get capital calls or provide capital calls. Here are the consequences of not doing it. Here's exactly how our distribution waterfall is spelled out, and everything related to the fund terms will be there. The subscription documents consist of 2 different pieces. One is a subscription agreement and one is an investor questionnaire. These are the documents that the LP signs and agrees to directly in order to become admitted to the pool. So the subscription agreement says, hey, I'm an LP. I am going to fill out this questionnaire about me, and I promise all of it is true, and I didn't steal any money. I'm not wanted on some anti-money laundering list. So I promise I read everything that you provided, and I'm like good to go on making this investment. It's a bunch of representations and warranties by the LP in terms of who they are and how they're coming to the fund. The investor questionnaire is literally a questionnaire that's like, who are you? What's your name? Where were you formed? Why? And the reason that GPs want to ask these questions is because there are a ton of regulations and exemptions on which they rely on in order to operate the fund in the way that they want to within the regulatory scheme. And they need to make sure that the LPs that they admit to the fund are not going to bust any one of the exemptions, or aren't going to cause them a red flag, that they are meeting their own obligations and duties as a GP and making sure that everyone is above board. I'll skip to offering, because like what that means, for example, is like if you have a fund that's relying on this exemption that says, hey, my fund also doesn't need to give super detailed information like all of these other public trading funds, etc. I'm going to be less regulated because my things are private. If you recall our like discussion about public and private assets, but I'm going to limit my fund to, less than 100 beneficial owners. Well, to actually do that and meet those thresholds, you need to know how many beneficial owners every single LP that comes to your door has. 506B, 506C, also regulations on how you talk about your fund and whether or not you can talk about your fund publicly. 506B says, hey, like, don't talk about your fund publicly. Everything is private. But then if someone shows up at your door and is like, hey, I am who I say I am, trust me, I'm accredited, I have enough money in my bank account, we're good, that might be enough. 506C is about doing a public offering where you can go out and talk about your fund, etc. But then if you have a ad on the side of the highway going to SFO that says invest in my fund, and then I show up and I'm like, hey, I'm Rita, I'm super trustworthy, don't you worry, like I have no problems. The SEC says, no, you can't rely on that. There's a little bit more verification you're going to have to do for those types of people. These are the types of things that you want your questionnaire to be covering, and you want to make sure that you're working with counsel to make sure are teed up. Back to the middle, investment advisor considerations. This is just like, if you're managing money, you're more than likely to be regulated, and figuring out exactly how. So what's your strategy? How much money are you regulating? What state are you in? And based on that, you can figure out kind of, are you going to be a registered investment advisor? Is there an exemption to that you can rely on? Are there different rules at a state? And like figuring out that whole process. I know I jumped through only extraordinarily meaty topics extraordinarily quickly, but I'll stop here and see if we have questions.
For sure. Thank you so much, Rita. That was super informative. I know we do have several questions coming in. And I think there's some clarification needed around the 2 and 20 split. If you could potentially run through that again. So where does the 2%, I'm happy to jump in here too, but where does the 2% go to the management company and what that actually is broken down into? And then what the 20% carry means for the GPs, for specifically like if you're a solo GP, for example, if we use that as the
So when we talk about GP, I think there's some confusion of terminology generally. I think most people managing money call themselves GPs. Here, I kind of want to separate out that concept from the like legal entity that is formally set to manage the pool as a GP from the management company, because the entity that is the GP can have multiple people that are making investments or managing it. And so you can have multiple other co-GPs in the colloquial sense. You could be one person. So like who actually keeps that 20% like is a separate question. So in this case, what we're talking about is kind of the fees from the pool that get paid out. So the management fee, I saw some of the questions are like, is it per year? Is it forever? So the idea is typically like, often it gets paid quarterly. The idea is, yes, 2% of committed capital gets paid out to the management company, regardless of like performance. Often there are different measures around that. You can start high and then come down later. There's also a flipping point. So in the life of a fund, there's a portion at which where you're seeking new investments and you're making investments, right? So let's call that the deployment period. Often in the first 3, 4, 5 years of the fund, you are actively set out as your mandate to go find new investments and take money from that pool and make those investments so that you can have a portfolio company 1, 2, and 3. Oh, and that should say 3. After a certain point in time, the LPA will say, stop making new investments. We are good and we don't need you to keep going out and making new investments. And this is market terms. What I want you to do is like focus on the investments you have and make sure that you're managing, overseeing them, and like helping them along. And so the only things you can do with our money at this point is pay other expenses that come up, or if there are follow-on rounds, like make the decisions about whether or not you're going to make follow-on rounds. That's all you're supposed to be doing. So if we think about the management fee as compensating the management company for making investment decisions, some people say it doesn't make sense to still charge 2% on capital or committed capital after that point. So what happens often is like the management fee will flip. Instead of making it a charge based on committed capital, maybe it's a charge of like how much was actually invested. Maybe instead you want to be very LP friendly and say there's going to be a step down. We're going to have actually a schedule and we're going to drop the percentages by, let's say, like 0.25% each quarter or each year or something in the period after the deployment period, the like harvesting period, where what you should be seeing is like the returns from your investments. So again, you can kind of see how this like ties back to our original point, which is the management fee is really set to like pay the management company for its ongoing fees for setting up all that kind of logistical stuff, your rent, your electricity bills, your subscriptions to news sources, whatever it is, and to be compensating them for helping make investment management decisions. That's also why there tends to be a flip in the definition. So go look at your LPAs or other LPAs into how that gets stepped down. So put that to one side. The distribution waterfall in terms of like how carried interest comes up is all related to money that comes back from your investments. So you made investment 1, you made investment 2, you made investment 3. Maybe investment 1 hit it out of the ballpark. You have a huge amount of returns, you pay everyone back and make them whole, and then there's a huge bucket of money that still needs to be divided. That's the amount of money that then gets split 80-20. And again, after the 20 goes up to the entity GP, then maybe you have 5 different GPs who are managing the fund and you've determined that all 5 of you get it equally. Maybe one GP was managing this fund and maybe one person gets it. That you decide at that level. So like all of those conversations come after. As far as I'm concerned, 20% of the returns of profit from that investment flow up to the entity that is a GP. Then you can decide how to divide it further. 80% of the profits are going back across your LPs. Hopefully that helps.
Yeah, for sure. And then in terms of an example of what this might look like, say you have a $10 million fund that you're raising, right? 2% would be $200,000 going down to management fees, which the GPs will use to cover all of the costs that Rita mentioned. So marketing, rent, you name it, getting access to PitchBook, and then salaries as well for the GPs. And 2% isn't a hard and fast number. I think Rita mentioned this before. You can go up to 3, you can go down to 1, depending on what you want to do and attract different types of LPs. You can shift what this number looks like. And I love that you mentioned that there's a step down approach as well. So you can start with 2%. And then once the fund gets going year over year, you start decreasing the management fee. So you have more money to invest with. So just kind of like a visual or example there. All right. So, and Tim, I love this question too, which is in line with it. So your perspective on lowering carry strategically, this is more in line with SPVs, but even kind of the larger idea of lowering carry for down to 15 or 10% to get more investor LP interest. Have you heard anything about that, Rita?
Definitely. And I think especially, I know you mentioned SPV, and I think let's even separate that a little bit further and go into a little bit more detail. So one is there are market standards, and especially as an emerging manager, a good rule of advice is also not to be too creative about your fee structures, because LPs know market terms. And so any deviation from it is actually going to take extra work for them to parse through. Of course, making the market terms better, especially if easy to understand, would definitely be interesting. But one thing to note is like too much creativity may actually work against you. Yes, I have seen investors kind of sweeten the pot in terms of their amount of carry that they take in order to attract LP interest. But again, the market standard is 80-20. So I'd really question like exactly why you would hold yourself out to be extraordinarily different from that. For SPVs, it tends to be a different ballgame because it really depends on like how that investment opportunity came up and how you're holding yourself out. In some cases, there are like some norms about when you do charge, let's say, carry or even management fees for SPVs, and it really depends. So say you don't have a fund, you are building a track record, you are starting to get allocations and options to invest in different companies, and you're setting up standalone SPVs in order to do that. I think charging like regular management fees carry makes sense, right? Because these are investment opportunities that you're sourcing, you're managing like you would any other like investor is managing a fund. However, often SPVs can also be set up for different purposes, meaning what happens if your fund, for example, makes an investment in a company, but because of different concentration limits, because you're out of the deployment period or what have you, the fund is actually not able to take advantage of the full allocation that the company provided it. So maybe those managers set up an SPV and allow some of the LPs in the fund to co-invest and like double down on that investment and add more money. Well, in that case, like you've done the investment research with a 2% fee, you've sourced the deal and any of the returns are going to come there. Sometimes like the managers in that case will say, we're not going to charge fee, we're not going to charge carry. We're just here to make this a good opportunity for everyone to just get more money basically from this deal rather than make kind of like double the charge on an investment that would have been here anyway. So I think it really depends in terms of like what the context for the deal source came from, in terms of like how you think about what fees you charge at the SPV level.
For sure. And it's a very strategic question. You can, and to your point, Rita, there are market standards for a reason. If you start to deviate and get super creative with your fee structures, it's going to raise up some flags, not necessarily in a bad way or a good way, but there's going to be questions from LPs, and really be considerate of what you want to do with both of these numbers, right? So depending on who your LPs are and if you're doing an SPV as well. For Tim, the rolling funds versus closed funds and SPVs, do you have any insight there, Rita? I'm happy to answer this one as well, since I've done all three.
Maybe I can lay the framework for how they differ, and then I'd love to hear your experience as well.
Sure.
Here, I can stop sharing this. So we just talked about kind of a harvesting or an investment period when you are managing a fund, which is the time in which you seek investments and come back. And then like a harvesting period, which is like when you're kind of sitting on the bets you made and like helping them to actually grow as much as possible. Another piece of that is kind of your fundraising period. And that happens from the first day you close your first closing, typically to 12 months thereafter. Maybe you have extensions, maybe you can extend it. But typically within the first 12 months from the date of your first close, that's the opportunity where the manager, the GPs can go out and basically fundraise to find LPs, to find the take my monies in order to enter the fund. So after the 1 year that closes, then you have your, investment period. Remember, we're looking for companies and we're going to invest in them. Then you have your harvesting period, and then 10 years later, everything should wrap up and close. Maybe there's an extension of 1 or 2 years, the last 12 years, the last 13 years, but this is what a closed-ended fund means. There's like a life cycle that the fund exists within, and those are the expectations. So for a rolling fund, instead of having 1 year of time in order to add LPs and to fundraise, and just a couple years for your investment period, instead this says, let's throw that out the window and kind of keep everything open and rolling. And so different LPs can maybe join quarterly, maybe join semi-annually, whatever the cadence is, and we're going to keep making investments the whole time. And depending on what cohort is in where, we're going to figure out how to pay each people appropriately into a rolling fund. So obviously an advantage is like you can continuously keep fundraising. You're not limited to a set amount of time to find people to enter your fund. And you can continuously keep finding investment opportunities so that you're not set to investment period in order to find companies to invest in. The one thing I would flag, and the other hand, is like, as an LP, then I know my GP is not really focused just on making good investments or helping the companies kind of reach that growing and maturing phase so that we can exit. Instead, they're also constantly fundraising and also constantly have their eyes open for the next big thing. So it really brings, at least from LP's perspective, into question, like, what exactly are you spending your time on and how? So I think like from that perspective, those are two different ways that I would balance some of the pros and cons. Patrick, I'm curious your reaction for the rolling fund.
Yeah, for sure. I'll combine this with Fiona's question about the need for first-time VCs to show experience and track record. The way that I've used a rolling fund and SPVs to my advantage to help launch Chasing Rainbows as a closed VC fund is essentially establishing that track record. Rolling funds you could use strategically, and for a year period, for example, you're allowed up to 99 LPs over that entire year based on quarters. And you could invest in a couple deals Q1, raise again, invest Q2, Q3, Q4. And then you have 6, 7, 15, 20 deals that you've invested in, right? So you have a track record now, you've made those deals, you've created relationships with high net worth individuals and LPs. And if you want to continue with the rolling fund, you're actually limited to the amount that you're allowed to invest in a rolling fund. I believe it's 100 million, but I'll have to double check that number. So once you hit that cap, then you have to roll up to a closed fund anyway. You can no longer deploy capital. But rolling funds and SPVs are a great way for you to establish a track record if you're not ready or you don't have the network yet to raise the full closed fund. And that's exactly what we did at Chasing Rainbows. And a lot of folks do that if they don't have the capital to be a full-fledged angel investor, for example, to make big checks, they can start an SPV, for example, and provide a smaller check and then pool money from all of their friends and family or folks in their network that can provide the money for that SPV investment. So it's all kind of intertwined. For us, the end goal was to get to a closed fund. That's oftentimes the life cycle of folks that start with rolling funds. Some people love rolling funds and then just roll on to the next rolling fund once they hit that cap. That's their prerogative. But for us, we just did it all quite strategically. Groovy. Let's see. Can you speak a little bit to cashless capital of a fund, Rita? Do you know much about that specific topic?
Yeah, so, and it's worth taking a step back to align incentives in the fund. So say you are Ash Ketchum, you're managing the pool, you're looking for Pokemon, and you know, as we just discussed, that the way that you're going to get paid is to have outsized returns so that that 20% of the profits is going to be as big as possible. Well, maybe that's going to change your incentives in terms of the types of things you're going to invest in, because now you're only looking for absolute blockbusters, regardless of how sensible or not it might be. And LPs want to know that at the very least, your incentives are kind of aligned with them, which is they don't want to lose all of their money to zero because you made so many big bets and none of them paid off. And so one way to align incentives is for the GP itself to also commit capital into the pool. So we talked about LPs, third-party investors putting money into the pool. Well, typically the GP also puts money into the pool. And that way, if truly you're making bets where everything goes to zero, you are going to be out of money as well. And that's one way for the LPs to make sure that the GPs are also aligned in terms of making sensible investments. And so typically the GPs in this can be a moving target, especially in earlier stages, but anywhere between like, let's say 1 to 2, maybe even up to 3%, depending on like the strategy. The GP will say, okay, whatever my total pool of committed capital I get from the third party LPs will be, I'll put in say 2% of that as like the GP's contribution to the pool as well. And that will also be part of like the distribution waterfall. Cashless contributions tends to be when instead of actually putting in money into the pool, the GP can say, well, rather than doing that, I'll forego any returns that I might get from that distribution waterfall. The thing with this is like, it's, I think, becoming more common, or in environments like this, a lot of people will look to it because capital can be harder to come by. At the same time, I think it can be quite complex. And I think some LPs may be comfortable with it, but some may not. And so I think it's something to consider in terms of like how important it is for you to have this provision and whether or not LPs are going to push back on it. I certainly think you can go out with it in your fundraising and like test the waters, and just make sure that your fund admins, any of your accountants, everyone is on board and comfortable with the procedures and process in terms of how to do the math, because I think these are areas where things can be quite complicated. Same thing happens for a management company too. Sometimes like there are mechanisms where you can waive management fees in return to getting first dibs on waterfalls. All that is like extraordinarily complicated, I think, for an emerging managers with different incentives and ways to get around different tax treatment and try to like spruce up returns for the GP or management company. Again, I think if you're going to be looking into any one of these particular mechanisms, really make sure you understand it, work with your counsel to understand exactly how the mechanisms work, make sure your service providers understand how to do any of the calculations, because that can be complicated and can get messy quickly.
Awesome. Thank you for that. So a couple questions from that are specifically around exemptions for RIA and fund size.
Yeah.
Do you have any insight around like how large your fund needs to be in order to qualify for an exemption? Is that even an exemption that exists? And then get into what that looks like.
Yeah. So the way to think about, so you're managing money and now you have to figure out like what kind of manager you might need to be. Typically the SEC or state regulator wants to know if you're managing other people's money for a fee. And so that's why you have to, based on in the Investment Advisors Act, look at these regulations and see where you fit. Considering the context for this, if you're a venture capital manager, there's a specific definition for what that means. It means you are managing only venture capital funds. Okay, so what does venture capital funds mean? Venture capital funds in turn means that at least 80% of the fund is going to be invested in qualified investments. What does that mean? Well, what the SEC really wants to see here and with this exemption is that you are purchasing directly, not on the secondary market, private shares or equity in private companies. So what that really is getting at is we want you to be doing direct investments into private companies, which is what you as a VC are holding yourself out to be. The 20% of up to 20% of things can be non-qualifying. So that includes anything secondary. So you're not getting shares in a private company directly from the company, but you found another person who was issued shares who now wants to sell them and you're buying it from them. That could be a secondary. Any crypto or digital assets investments, those are non-qualifying. Any debt related instruments, non-qualifying. So there's a small bucket of stuff that would fit into non-qualifying if you want to hold yourself out to be a venture investor, in which case 80% at least of each one of the funds that you manage needs to be in direct equities in private companies. To rely on that exemption, there's no dollar limit. So your funds can be as big or as small as you want them, so long as you're complying with these percentages. Really interestingly, I know like several years ago, so in Driscoll, like it caused a huge uproar, like, you know, stirring in the market when they had to register as an investment advisor. Well, the reason they did that, even though they were managing like hundreds and hundreds of millions of dollars, the reason they did that is because they wanted to launch their standalone crypto funds. And as we just discussed, a standalone crypto fund would have certainly more than 20% of investments in digital assets that would bust the venture capital exemption. So Andreessen would no longer be able to rely on a venture capital exemption as an investment advisor if they also wanted to manage that fund. There's a different exemption that I'll just flag, which is the private funds exemption that is related to size up to $150 million of money under management. And so that could be another alternative depending on what kind of strategies you're pursuing. Otherwise, RIAs, registered investment advisors, are registering with the SEC. Now, another asterisk to put on all this is like, the states actually are bifurcated from the SEC. So it's depending on where you sit and how much money you manage, there may be other exemptions available to you that could be even more simple or different from these exemptions. And so this is where I think it's helpful to talk with a lawyer, figure out where your home base is, figure out what the state regs are, how much money you're managing, and where the SEC can come in. Often the rule of thumb is like, if you're managing less than about $25 million, state regulators are usually regulating you. If you're anywhere between like 25 to 125 or like, and I forget the exact number, either state regs may apply if they exist, or you get kicked off to the SEC already. Above that, or 150 million, I can't recall, you're in the SEC's territory. So those are also kind of another layer to think about when you're trying to figure out kind of like what kind of advisor rules to comply with.
Awesome. We're nearly out of time. So maybe like a quick, just general question for you, Rita. If someone's looking to get involved in VC and set themselves up for success, what recommendations would you have? Obviously, no legal advice is being shared here, but how would you do it if you were setting yourself up to get involved in VC?
Yeah, I think like the reason for why is really important. And I'd be curious, like, do you already have deal flow? Are you already interested in like allocating money to different investments? And if so, I see one of the questions is like, what kind of lawyers do you talk to? On the fund side, you talk to fund lawyers. So there are fund formation attorneys or investment fund attorneys who specialize in setting up the funds. Then when you're going to turn around and make investments into portfolio companies, you often get handed over to, you know, ECVC or like deal focused attorneys who are instead helping you manage term sheets for any investment. In terms of setting yourself up for long-term success, definitely like think about your strategy, who you are and why you're setting out to do what you do. Every manager has to hold themselves out to the market and have a differentiated way of presenting themselves. What is your specialty? Is there something unique about your or your team's background that's going to get you differentiated access to deals and therefore to returns that LPs are going to be looking for? Think about like what size of checks you intend to be writing and how that could come into the total size of a fund that you might want to be targeting, and have like a sensible, like logical connectivity between all of those threads. And finally, I think having your back office and operations set up in a sensible way will also give LPs credibility when you're an emerging manager. So when they know that you are working with reputable banks, auditors, funds, and this is my personal opinion, you have good back office setups and they know that they have good transparency, I think that will help lend credibility to first-time fund managers who are still on the path to like building out their track records and really demonstrating years of success.
Amazing. There's so many questions that are still unanswered, but unfortunately we are out of time. So I wanted to again express my immense gratitude to Rita for being here to answer these questions. We'll try to in the email follow-up respond to as many as we can, just to make sure that we cross all those T's and dot all those I's. So thanks again, Rita. Again, my name is Patrick. It's been my pleasure to moderate this and to hear from Rita as well. Two quick plugs I wanted to share with everyone before we jump. One is Carta is actually having an equity summit next week on December 7th. I've seen many questions around SPVs. One of the sessions is specifically focusing on SPVs. There's a ton of great topics focused on LP communications, LP best practices. So you learn a lot through that all-day event on December 7th. You can search Carta Equity Summit. It'll be the first thing that pops up, and feel free to register there. Can't recommend it enough. And then again, it's the last day to sign up for Startout's Growth Lab. So make sure you get on to Startup's website if you are a founder. If you are an investor in this room and are curious about deal flow specifically from Startout, sign up for the investor portal and you'll receive weekly, bi-weekly, monthly updates on new deal flow opportunities. With that, any final words, Rita?
Thank you so much for having me. And if anyone is interested in talking about structures or what Carta could do to help, whether it's on SPVs, fund formation, or fund admin, feel free to reach out to me. I'm always happy to chat.
Thank you so much, everyone. Have a great rest of your day.
Thank you.